There is a belief in Britain that is so deeply embedded in our culture, so thoroughly accepted as financial common sense, that most people never actually question whether it is true. That belief is this: renting is throwing money away, and buying a home is always, automatically, the financially superior choice. Landlords, parents, financial commentators, and politicians have been repeating this idea for decades. And for a significant portion of British economic history, they were broadly right. But in 2026, the numbers tell a story that is considerably more complicated than that simple version suggests. And the honest truth is that whether renting or buying builds more wealth in the UK right now depends on where you live, how long you stay, how much deposit you have, what you do with your money if you do not buy, and a set of costs that almost nobody includes when they do this comparison casually over a kitchen table. Today, we are going to do this properly. We are going to run the real numbers, include the costs that usually get left out, and give you an honest framework for making this decision based on your actual situation rather than inherited cultural wisdom. Let's start with the current state of the market, because the numbers in 2026 are genuinely unusual in several ways. The ONS reports average UK house prices at £290,000 as of January 2026. Average UK private rents rose 9% in the 12 months to January 2026. Average monthly rent across Great Britain is currently £1,547, while the average new mortgage repayment is £1,670, a gap of £123 per month. So on a pure monthly payment basis right now, renting is cheaper than buying in most parts of the country. That gap is not enormous, but it is real, and it matters for the calculation. As of April 2026, the average 5-year fixed residential mortgage rate is 5.75%, and the average 2-year fix is 5.84%, with the best deals at 60% loan to value around 4.71%. The Bank of England base rate held at 3.75% in April 2026, with markets pricing further cuts later in the year. And around 40% of UK homes are now cheaper to buy than rent, with fixed mortgage rates stabilizing between 3.5 and 4.5% for lower loan-to-value borrowers. What all of this tells you is that the picture in 2026 is highly regional, highly dependent on deposit size and mortgage rates secured, and not as simple as either side of this debate usually presents. So let's build the real comparison from first principles. Scenario 1. You are a single person in the UK. You have £60,000 in savings. You are deciding between using that as a deposit to buy a property or continuing to rent and investing the money elsewhere. Your property of interest costs £300,000. The region you live in has average rental costs of £1,300 per month for an equivalent property. If you buy, here is what the full cost picture looks like. Your £60,000 deposit is 20% of the purchase price, which avoids lender's mortgage insurance. You take a mortgage of £240,000 at 4.5% over 25 years. Your monthly mortgage payment is approximately £1,330. That is actually lower than the equivalent rent in our scenario. On a pure monthly cash flow basis, buying wins immediately. But here is what the casual comparison misses entirely: the upfront costs of buying. Stamp duty on a £300,000 property for a first-time buyer in England is currently £5,000 on the portion above £250,000. Legal fees for conveyancing typically run between £1,000 and £2,000. A survey and valuation adds between £500 and £1,500. Mortgage arrangement fees can be up to £1,000 to £2,000. Total upfront costs above your deposit at a minimum £4,500 to £10,500. Let us call it £7,500 in a realistic scenario. That £7,500 is gone the day you complete. It does not form part of your property's value. It does not earn a return. It is a pure cost of entry that a renter never pays. And then there are the ongoing ownership costs that renters do not have. Buildings insurance, which is typically £200 to £400 per year. Maintenance and repairs, which for a typical UK property average approximately 1 to 2% of the property value per year when measured honestly across the full range of things that can go wrong with a building over time. On a £300,000 property, that is £3,000 to £6,000 per year, or £250 to £500 per month on average. Council tax and utilities are roughly equivalent for renter and buyer of the same property, so we set those aside. Service charges and ground rent if you are buying a leasehold flat can add several £1,000s per year on top. And when you eventually sell, estate agent fees of 1 to 2% of the sale price, plus further legal costs, will cost you £3,000 to £6,000 or more on exit. These costs do not disappear when you add them up. They are real money that a renter does not spend. So let's run the honest 10-year comparison. You buy the £300,000 property. Over 10 years, assuming 3% annual house price growth, which is broadly in line with historical UK averages over the long run, the property is worth approximately £403,000. Your mortgage balance after 10 years of repayment is approximately £188,000. Your equity is therefore approximately £215,000. From that, you subtract your original deposit of $60,000, which was your starting capital, and you are left with a net gain on capital of approximately £155,000 over 10 years. But from that gain, you also subtract the upfront costs of $7,500, the maintenance costs of approximately $36,000 over 10 years, assuming £360 per month average, the insurance costs of approximately $3,000 over 10 years, and the eventual selling costs of approximately $6,000 to $8,000. Total cost adjustments of approximately £55,000 to £60,000. Adjusted net gain from buying, approximately £95,000 to £100,000 over 10 years on your £60,000 investment. That is a strong return. Now let's run the renting and investing scenario with the same starting capital. You do not buy. You keep your £60,000. You invest it in a low-cost global equity index tracker inside a stocks and shares ISA. You also invest the difference between what you would have paid in mortgage payments and what you actually pay in rent each month. In our scenario, the mortgage payment would have been £1,330 and rent is £1,300, so the monthly saving is only £30, but you also save by not spending on maintenance. Let us assume you redirect £250 per month, the average maintenance saving, into your ISA alongside your lump sum. Your £60,000 initial investment plus £250 per month added to it, all growing at 7% per year inside an ISA over 10 years. The £60,000 grows to approximately £118,000. The £250 per month contributions add approximately £43,000. Total portfolio value after 10 years, approximately £161,000. Your starting capital was $60,000, so your net gain is approximately £101,000 over 10 years. That is very close to the buying outcome. And this is the honest answer to the rent versus buy question in 2026. In many scenarios, over a 10-year horizon, the outcomes are closer than almost everyone assumes. The buyer benefits from leverage, which amplifies the return from house price growth. But the buyer also pays costs that the renter avoids, and the renter who invests the capital and the monthly savings disciplined can produce a comparable outcome. The key word there is disciplined. The renter who invests all of the freed-up capital and the monthly savings consistently every single month for the full 10 years in a low-cost diversified portfolio without touching it performs comparably to the buyer. The renter who does not invest the difference and simply spends the money on lifestyle will dramatically underperform the buyer over the same period. This is the critical distinction that almost every rent versus buy conversation ignores. Renting is not automatically worse than buying. But renting and investing is competitive with buying. Renting and spending is financially catastrophic over the long term. Now let's talk about the factors that genuinely shift the calculation in favor of one side or the other. The calculation shifts dramatically in favor of buying if you plan to stay in the property for more than 10 years. The upfront costs, which are fixed at purchase regardless of how long you stay, are amortized over a longer period, making them progressively less significant per year. The leverage on house price growth continues to compound, and the mortgage balance continues to fall, building equity automatically. The conventional UK rule of thumb is 5 to 7 years as the minimum holding period to justify buying over renting when all costs are included. At current 2026 rates, the break-even tends to land at the longer end, 7 to 10 years, because mortgage rates of around 5.75% mean monthly buying costs exceed rent for the average UK property. If you are confident you will stay in the same location for 10 or more years, buying is very likely the stronger wealth-building strategy, assuming you can afford the deposit and the full cost of ownership without overextending yourself. The calculation shifts in favor of renting if you plan to move within 5 years. The upfront and exit costs of buying are brutal over short holding periods. Someone who buys for 3 years and then sells will typically be worse off than they would have been renting, because the stamp duty, legal fees, and selling costs are spread over too short a period to be offset by price growth or equity building. The calculation also shifts significantly by location. London presents one of the most dramatic examples of the regional divergence. In Westminster, renting runs £1,290 per month cheaper than buying the equivalent property. In parts of the Northeast, the monthly cost of buying is lower than renting an equivalent property. The Northeast has average house prices of £184,000 with annual growth of 5%. The Northwest offers similarly favorable affordability relative to the South. For someone buying in the Northeast or Northwest with a reasonable deposit, buying may be immediately cheaper on a monthly basis than renting, and the 10-year wealth-building case for buying is very strong. For someone in inner London, the monthly premium for buying over renting is so large that the invested alternative becomes extremely competitive. The calculation is also heavily influenced by what happens to rents. The ONS price index of private rents shows UK average rent grew 3.4% in the 12 months to March 2026, down from recent highs, but still above wage growth in many sectors. At 9% annual rent increases, a tenant paying £1,200 per month today will pay approximately £1,870 per month by year 10. With total rent paid over 10 years amounting to approximately £194,000. Rent increases are one of the most powerful arguments for buying because while your mortgage payment is fixed for the duration of your fixed rate period and eventually disappears entirely, your rent rises every year. Over a 20-year period, the cumulative difference between a fixed mortgage payment and a rising rent payment can be very large indeed. The bought property becomes progressively cheaper in real terms as wages and inflation erode the fixed mortgage payment. The rented property becomes progressively more expensive as landlords raise rents in line with the market. There is also the retirement dimension, which almost nobody includes in this comparison, but which may be the most important factor of all. The person who buys and pays off their mortgage before retirement owns their home with no ongoing housing cost except maintenance and council tax. Their retirement income goes entirely toward lifestyle rather than housing. The person who rents throughout their life enters retirement with a continuing monthly rent payment that will rise with inflation every year and which they must fund from their pension and savings for as long as they live. If rent is £1,500 per month in today's money and inflation averages 3%, the rent in 30 years will be approximately £3,600 per month in nominal terms. That is a significant ongoing cost that a mortgage-free homeowner does not face. Over a 20 to 30-year retirement, the cumulative housing cost advantage of owning outright is enormous, potentially exceeding £300,000 to £500,000, depending on the level of rent and the length of retirement. So what is the honest answer to which one builds more wealth in the UK in 2026? The honest answer is that buying almost always wins over the long run of 20 years or more, primarily because of the retirement advantage, the leverage effect of house price growth compounding over decades, and the eventual elimination of housing costs in retirement. But the margin of advantage is not as large as most people assume, particularly over shorter horizons, and it comes with real conditions attached. The buyer must stay long enough to amortize the upfront and exit costs. The buyer must be able to afford the full cost of ownership without overextending. The buyer must buy in a location with reasonable long-term price growth prospects. And the buyer must understand that a house is not a liquid investment. You cannot sell 5% of your house in March when you need cash. The renter who invests the deposit and the monthly savings in a diversified ISA portfolio is not making a catastrophically poor financial decision. They are making a different trade-off. They are buying flexibility, liquidity, and freedom from maintenance stress at the cost of the leverage and the long-run equity building that ownership provides. Whether that trade-off is right for you depends on your location, your income, your stability, your timeline, and your discipline. It does not depend on whether your parents' generation thinks renting is throwing money away. That belief was formed in an era when house prices were 4 times income. Today, they are 8 times income. The calculation has changed. The wisdom has not updated to match. If this gave you a clearer picture of the real numbers, please hit the like button and subscribe to UK Finance with Peter for more honest, practical content on money and housing for people living and working in the UK. Thanks for watching, and I will see you in the next one.